Diversified growth funds really developed as a response to the bear market back in 2000-2001 when equity markets fell substantially, and traditionally investors in the defined benefit arena and the defined contribution arena had balanced portfolios.
And those products were very equity heavy, and so in times of volatility they actually produce quite volatile returns which investors found quite uncomfortable and difficult to cope with.
There's quite a broad range of objectives and also approaches to diversified growth funds, ranging from some which are effectively hedge funds to others which are almost the same as old-fashioned balanced funds, and we sit somewhere in between that.
The team that runs the fund consists of myself as essentially the lead manager, and I'm supported by two co-leads, Fiona Gillespie and Mark Parry. We split up responsibility according to the type of asset class that we're investing in. Mark Parry's experience in terms of his many years in the industry lies in the fixed income world, and Fiona Gillespie's experience lies in the equity world. I myself look at everything, including the alternative arena.
We have a strong team based out in Singapore who manage Asian fixed interest products. We have a very well-respected equity team based in the Far East who manage a number of Asian equity products. And we have our emerging markets team based in London. The funds that we like to manage are those where the investors can see what's in them. They're quite easily to understand the assets underneath. We tend not to use complex derivative structures or synthetic type investments.
Aberdeen's approach to running a diversified growth fund is to emphasise investment in the higher growth regions of the world, namely Asian and the emerging country world, because we believe that still there are opportunities there to get superior return profile for investments. And that doesn't include just the equity markets, it also includes bond markets.
Pension schemes should be looking at diversified growth funds to really smooth the volatility of their returns. That's the main purpose of having them. So over a 3 to 5 year period, you're looking for a reasonable return similar to that you may get from equities, possibly slightly lower, but in the same ballpark. But the key role of diversified growth fund is to take out the peaks and troughs in terms of volatility that you would experience if you were a large investor within equity markets.
There are clearly differences between the risk and return profiles for defined benefit and defined contribution schemes. What a diversified growth fund can do is just offer a different risk-return profile, which we think could be useful to both potential user groups.
The diversified growth fund marketplace is actually estimated by some industry reports at up to £150 billion in terms of assets. The number of products that are available in its widest sense is something approaching 90 in terms of funds available. And indeed, in terms of the usage of those products, we've increasingly seen the local authority arena, by some industry estimates, putting something like 12 to 13% of their asset pool into these types of vehicles.
Although the Aberdeen Diversified Growth Fund is just over a year old, it's had a very good first year. Aberdeen's been managing multi-asset for a number of years now. Our flagship multi-asset fund indeed has just had its 10th birthday. So the idea of multi-asset investing is nothing new to us. What is new though is the way that we can apply it given the different range of investment instruments we have available. So we can be truly dynamic with a diversified growth fund.
The investment philosophy that Aberdeen believes in is that there is value to be created by switching between different asset classes.
Put simply, we're managing risk. What level of return can we generate for a certain level of risk and a certain level of volatility? How can we smooth the path of returns and manage that volatility over time? We'd say that asset allocation and stock selection are both important drivers of return. What we're trying to do is spread the risks across our investment portfolio so no one single investment risk dominates.
The Aberdeen Diversified Growth Fund targets a cash, or LIBOR is the official word for it, plus 4.5%, and that's really over a 3 to 5 year time horizon. So within there that should allow you to deal with the ups and downs of the various asset classes within the structure of the fund.
Aberdeen's USP in terms of its diversified growth fund product really centres on our expertise, our core franchise in the Asian and emerging world.
The transparency within the fund is very important. Investors like to be able to understand the portfolio and like to be able to see exactly what's under the bonnet, if you like, of the diversified growth fund.
In today's troubled economic environment, growth is much harder to come by. And because of the strength of depth, particularly of the emerging market expertise at Aberdeen, we're able to go to that in debt or equity space to access that growth and then put it together in a portfolio that we believe makes sense in today's volatile world.